Good afternoon. Market news now. Stocks across Asia jumped, bouncing back from yesterday's losses as Wall Street rallied on optimism that the Omicron variant risk might not be as bad as feared. Hong Kong's Hang Seng Index jumping 2.7% as casino and property shares rose. Tech stocks also recovered from the previous session, with Tencent up 3.5% and Alibaba soaring up 12.2%. Over in Europe, the strong European stocks came, of course, after the region moved higher on global markets, as well as we have seen them rally, with concerns again about the potential severity of the Omicron variant easing. Investors are betting that the new COVID-19 strain may cause milder illness than feared. Meanwhile, investors are also weighing the likelihood that the Federal Reserve would begin to remove its massive pandemic easing policies and hike rates sooner than expected. To give us perspective on how all of this is playing locally with our markets, we are joined by Maurice Madiba, who is the CEO of Cloud Atlas Investing. Maurice, thank you so much for your time. So right now, it seems as though markets are moving in whatever direction news around Omicron seems to be going. And at this point, it seems as though, it's not as feared. And you had U.S. Dr. Anthony Fauci echoing the same sentiments as well. How's all of that affecting our local markets?
Yes, so South Africa is seeing a little bit of suppressed returns in this environment where people are learning to deal and we're learning to live with the COVID variant and Omicron being discovered here. And also the world slapping us with a lot of travel restrictions, particularly around festive season, which is when a lot of tourists do descend upon the country for various destinations. And that's really having a negative sentiment on the business outlook for South Africa. But the rest of the world seems to be doing fairly well. We are seeing the risks around this variant and its potential effect on healthcare starting to ease up a little bit. As you know, whenever there's a new variant discovered, people do go into a panic mode, and choose to self-isolate quite a bit. But from the data that's been coming out so far, this variant is not causing as much death or hospitalization as its predecessors.
So earlier today on SENS, we had Time Bank, which is the emerging lender backed by African Rainbow Capital, announcing that it's picked up Tencent as an investor as it eyes, emerging market expansion. What's your view on Time Bank and the other banks such as, Bank Zero and Discovery Bank, especially as they try to compete for the consumer?
I think it's an exciting time in South Africa's banking industry. Previously, it's been dominated by the Big Four, and we did see Capitec come in as a new player and amass quite a good success story. But Time Bank is particularly interesting because they've just closed $180 million funding round, as you mentioned, backed by Tencent, which is also responsible for two largest companies on the JSE. And also the SABC group in the UK. And the difference between Time Bank and its other competitors or new banks that are being announced, in particular Discovery Bank and then also Bank Zero, is that it is accessible in your retail stores, and it's also managed to gather around 4 million new customers. So these are 4 million people who are testing the bank's capability of holding deposits. I think at present, Time Bank has just under 2 billion rand worth of deposits from individuals. So it's really on a kind of trajectory of growth profile that is going to be what we saw with Capitec some time back. And what it's all about is really advancing our sustainable development goals, which the world has signed on for globally. And part of that is reducing the fees and the fees to transact, and then also increasing people's access to financial products. So technology plays quite a big part in that. Time Bank has harnessed technology to be able to function and run. And so this funding round is not a surprise. The bank's not yet at break even. I think it's probably reaching there very fast. But, in a few years' time, it will be a player or force to be reckoned with.
Right, so let's move things stateside for a bit. I mean, last week you had news around the Fed. Some have described it as the Fed pivot. What's your assessment on how long the lasting impact is going to be of easy monetary policy starting to wind down?
Yeah, so this is a position we've been in before, around the 2014 period, between 2014 and 2017, when we had the 2012 euro debt crisis, where the Fed seems to be on a bit of a footing around how quickly to implement the retraction of its quantitative easing or the buybacks of its quantitative easing. So in this particular case, we are looking at November or last month was supposed to have been the start, but really seeing some data come out of the US, which has been encouraging. Like last week's initial jobless claims were quite positive. And this week, Friday, we're expecting to see what CPI does. And that's going to be quite a big input into the markets, given the fact that US had said, or the Fed had said, its inflation is transitionary. But we are seeing that inflation seems to have packed a much longer bag than just the last quarter of 2021. And so if these inflation numbers are high, it may mean that tapering has to happen much more rapidly than before. And it may also see us increasing interest rates in the US, which would be quite a more hawkish approach in the new year, where at least 2 interest rate hikes are expected.
On that note, then, some people have been saying that we could end up with the worst of two worlds, where on the one hand you have suppressed growth if Omicron comes back stronger than expected, and on the other hand, inflation, affecting, for example, supply chains. Are you factoring that at the back of your mind as well as a concern?
Most definitely. Omicron, though, does seem to be a little bit more manageable, although the initial reaction is being rather political and also rather harsh from the developed markets. But we are expecting inflation to be around the levels that it is, which could push the US yields slightly higher. Inflation is not a surprise in this particular point, given the fact that part of the stimulus that the US did in the past year has been giving its citizens free money to spend. So unfortunately, it seems that this inflation has been contained mainly in the USA and has not been a global issue where inflation is rising globally. So as we enter this festive season, we've just had Black Friday. And your Asian counterparts, as you mentioned earlier, have been doing exceptionally well. We're expecting that supply over the Christmas period and New Year is going to continue to be in place, and inflation potentially easing towards the later half of 2022.
Maurice, thank you so much for your time. Let's leave it there. That is Maurice Madiba, who is the CEO of Cloud Atlas Investing, giving us his perspective on how the markets are performing right now.